Welcome back, grade 12s. It's economics with me, Spiwe. Just before the ad break, we were looking at the informal sector and the employment opportunities that are brought by that particular sector. So we're going to continue with our lesson, and now we are going to move on to our next point. So we're looking at the Gr12 strategy, which was implemented to create positive climate that would be conducive to employment and the creation by the private sector. So let's go back here, because this, remember, is a macroeconomics. So it's a macroeconomic strategy that was introduced by the government of South Africa to look at growth, employment and redistribution. So it is a strategy. The strategy was put in place or was created in order to bring about a positive climate that would be conducive to employment creation by the private sector. So we will look at this later on in much more detail, but I think for now it is important that you just know that this is a macroeconomic strategy by the South African government, and it looks at growth and employment and also redistribution as well, as a strategy to create a positive climate that will be conducive to employment creation by the private sector. So that's one of the objectives of the government, is to grow the economy, create employment, but also look at the issue of redistribution, because it is an important issue that needs to happen in a country or in a government or in a state when you are looking at resources. So redistribution is one policy that we will also look at later on. Okay, so let's move on. Now we're going to look at the exchange rate. So that's going to be our third point, because full employment was our second point. So now we're looking at the exchange rate. So we know that each country has its own currency. In South Africa, we use the rand. In Botswana, they use the pula. In America, they use the US dollar. If you go to Britain or to the UK, they use the British pound. So each country has its own exchange rate or its own currency. And we know that we live in a global society where we are no longer self-sufficient as a country, and therefore we are now trading with other countries, because sometimes because of specialization, we end up with a surplus of resources, and therefore it's a good idea, or it is recommended, that we sell those to other countries who don't have those resources in order for us to generate an income. For example, South Africa has a good record, or has minerals, like gold. But we lack other minerals like oil, and therefore we depend on other countries for those minerals, and the ones that we have in abundance, we are able to trade them to other countries, and in that process generate an income. So we'll look at now the importance of the exchange rate stability, and the first point says, so effective fiscal and monetary policy can be used to keep the exchange rate at a relatively stable position. Okay, so we go back to the fiscal and monetary policies. We know that in order for the government to influence the business cycles, they would use these two policies, namely the fiscal policy and the monetary policy. So they can still use these policies in order to keep the exchange rate at a relatively stable position. And we know that if the exchange rate is at a stable position, that will encourage more imports and exports, because of the stable rand, or the exchange rate is considered to be stable at that particular point in time. And then we come across two important concepts over here. So we've got depreciation and appreciation of the currency. Those that do accounting, we know when we talk of the depreciation of assets, if you've purchased a vehicle and then once you drive it out of the dealership, and then they say it starts to depreciate, so the value drops, and then when it appreciates, then the value goes up. And we know with vehicles, they often depreciate rather than appreciate. But if you're looking at an asset like property, property appreciates if there's a demand for property, and property is also considered as a stable investment. So depreciation and appreciation also happens when we are looking at currencies. So depreciation and appreciation of the currency creates uncertainties for producers, traders, and it should be limited. Okay, so we've seen this where the rand had depreciated, the rand dropped. That will be the headline because of a political decision that was made, or because of a monetary or a fiscal policy that was made by Treasury. Or that was an announcement from the Minister of Finance regarding policy or certain economic decisions. So those decisions could make the currency to appreciate or to depreciate or appreciate. So when depreciate, so it drops, and then appreciate, it increases. Okay, so this is not good for producers and traders because they find it, when it's unstable, they don't like that. They find, they don't want to invest or to supply or to produce or manufacture if they feel that the currency is not stable. So it's important that we try and limit the movements in terms of depreciation and the appreciation of the currency. And then now the South African Reserve Bank, which is our central bank, changed the exchange rate from the managed floating to a free floating exchange rate. So now we know that the South African Reserve Bank is our central bank, and now they've changed the exchange rate from the managed floating to a free floating exchange rate. Okay, so you could be sitting there at home and say, hang on, Spio, what is a managed floating now and what is a free floating exchange rate? So in a managed floating current environment, it is where the currency could change from day to day, and then therefore the central bank will try and influence the exchange rate by buying and selling currencies. Okay, so here you had the involvement of the central bank. So in this particular instance, because we live in South Africa, our central bank is the South African Reserve Bank. So what they would do, they would try and influence the exchange rate by purchasing or buying the currencies and also selling them at the same time in order to try and influence the exchange rate. So now we've moved away from the managed floating into a free floating exchange, which is guided by the forex markets. Okay, and the forex markets will then determine the exchange rate based on supply and demand. Okay, so this is the ideal situation because now it is now based on supply and demand, and then the central bank is no longer playing that role where they tried to influence the exchange rate by buying and selling currency. So now it is all dependent on the forex market, and then this is determined by the supply and demand in that particular market. And now we're going to move on to point number 4. So I'm going to call that number 4, and we're looking at price stability. So stable prices, remember when we do economics, we like things to be stable, but they're not always stable. And therefore, hence, we need to have measures in place to respond to markets when they decide not to be stable. So stable prices lead to better results in terms of job creation and economic growth. So if our prices are stable, that means that there is now less inflation because that's a general and considerable increase in prices. So if our prices are stable, so that will lead to better results in terms of job creation and economic growth. And now we know that the South African Reserve Bank tries to keep a certain target when it comes to inflation, and the target is between 3 to 6%, and they have been very successful in keeping the inflation within this particular target. So that's one thing that's always positive about our economy, the fact that we have been so good when it comes to managing the inflation target, which should be between 3 to 6%. And we know that the Reserve Bank has been very successful in doing so, and they should continue to do that because we do encourage an economy that has stable prices, because we know that the stable prices will lead to better results, and then better results will lead to job creation, and job creation would lead to economic growth. So you should be able to link these things and not look at them in isolation, because it's important to show the link and how one factor actually influences the other in terms of making a positive or a negative contribution. So it's important to know that stable prices lead to better results in terms of job creation and economic growth. And we know that the South African Reserve Bank has been so good in keeping the inflation rate within its ideal targets. Now we come to interest rates. So we know that interest rates, so if you take out a loan from a commercial bank, you will be charged an interest rate. And then also banks approach the South African Reserve Bank for loans or money. And therefore they get charged what we call a repo rate. So when the repo rate goes up, the interest rates will also go up, because then the commercial banks will try and even out things, because now they know that they're paying a higher rate there, so they are going to charge us as consumers and households a higher rate when it comes to the interest rates. So interest rates based on the repo rate are the main instruments used to achieve price stability. Okay, so we know that there's that important interaction between the commercial banks and the South African Reserve Bank in making sure that prices are stable. And the repo rate, that's the percentage that is charged by the Reserve Bank to commercial banks when they approach the central bank for loans, or they want to access certain funds because they are running short. And then in return, they charge us interest rates when we approach a commercial bank and we take out a loan because we want to renovate our homes or we want to go on that nice holiday. So if you take out a loan, then you will be expected to pay it back with interest. And when banks approach the South African Reserve Bank, they will be charged a repo rate. And then moving on to a stable budget deficit. It is also important to have a stable budget deficit, because it does help to stabilize the inflation rate. So remember, it's important to be able to control and keep this target of 3 to 6% at all times. So in order for the Reserve Bank to meet this, or to continue to keep the target at or between those percentages, it's important that they look at interest rates and the repo rate. But also it's important to have a stable a budget, because that will also help in making sure that the inflation is being controlled, so that we don't have that general rise in prices, and that also the inflation target is being kept at the targeted percentage of between 3 to 6%. Okay, so let's go back. I like just going back and showing how all of this then links up at the end of the day, because we don't want to look at topics in isolation. We want to show how they are all related so that it makes more sense to us. So we've looked at the exchange rate, and we spoke of the fiscal and the monetary policies. So let me go up. So we've showed you that it's important for government to use the fiscal and monetary policies in order to keep the exchange rate at a relatively stable position. And we spoke about depreciation and the appreciation of the currency, and we said this is not good for the producers and traders, and this should be limited. And then we know that we've had so many issues with the rand. And then we said that the South African Reserve Bank changed the exchange rate from the managed floating to a free floating exchange rate. So when it was managed, the central bank did try to influence the exchange rate by buying and selling currencies. And then now that we are using the free floating approach, it means that now it is all determined by the forex markets based on supply and demand. And price stability is also important, because stable prices lead to better results when it comes to job creation and economic growth. So that's also another important thing that you need to note. And that is important that we continue to keep our target when it comes to the inflation rate, which is between 3 to 6%. And then also interest rates and the repo rate play an important part as instruments in price stability. So if we want to achieve price stability, we need to look at our interest rates and our repo rates as well. And also having a stable budget is another important factor when we are looking at stabilizing the inflation rate, because if our budget is stable, then we know that our prices will not increase because that will lead to a higher inflation rate. Well, we're going to take a short break, and I will catch you right after this.